Good morning, everybody. Welcome to the Block Thrasher Daily Crypto Update. Look at this. The market is up. We're going in the right direction. We're seeing green, 2.6%. Total market cap increase to $1.53 trillion. That is awesome. Welcome to another episode of the Block Thrasher Daily Crypto Update, where we are simplifying crypto, shattering the complexities with today's hottest news, commentary, analysis, and education. Yesterday, I was not able to record an episode, and I am so sorry. Have you ever had a season of your life where you just felt like the vehicle demons were after you or something? Where that's what I'm going through right now. It's like problem after problem after problem with these vehicles, and we have a number of them. We've got diesel trucks, and yesterday I was headed into town, and something I knew something was off a bit. Started to smell what smelled like burning brakes, and then when I let off the gas, the truck just like slowed down really quickly, like the brakes were being applied, even though I wasn't applying the brakes. And I pull over and I stop, and it smells bad. And I look at the brakes, and they're smoking, and the brakes had seized up. All four, as far as I could tell. The front's obviously, worse than the back because that's where most of the braking power comes from. And so I was like, oh, man. And obviously had to just sit there for a bit, threw some water on it, which, might have warped the rotors. But anyway, slowly, I was 5 miles away from home when I realized this was a problem. And it was the longest 5 miles ever back because it was just like 10, 20 miles an hour max. Just really taking care, make sure it didn't get too hot, start a fire, seize up, weld the pads to the rotors, etc. So anyway, apparently I am thinking that my ABS module is what went bad. So these newer vehicles have the ABS, right? The anti-lock brake system, which keeps the brakes from locking up and seizing up. And, when you start to slide, it kind of creates a pattern, like bump, 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 like you were pumping your foot really quickly on the brake, but it does it automatically. Think that failed. I'm hoping that's what it is. But anyway, I've got that and a master cylinder, and that's like the next thing. I do fix up my own vehicles generally for the most part. It's something that I like to do. And I can save some money that way and learn about, if I don't already know how it works better. So something I'll be tackling. But anyway, getting back to the cryptocurrency market. Our word of the day is fantast. Fantast. A person who is a fantast, kind of like think of fantasy. Fantast is a visionary or a dreamer. Fantast. Visionary or a dreamer. All right, let's get into this. We've got some good stuff to look at today, for sure. We're going to get back into our discussion on the insidious thief, which is inflation. But before we do that, let's just do our market wrap real quick and then take a look at some of the hottest news items of the day, the most important stories. So, as already stated, total market is up. We're seeing a lot of green. With Bitcoin, it's still in the red on the week, but up 2.2% in the last 24 hours. It is currently a range bound between 30 and 37, 38, 39 in there, and has been for the last 3 or 4 weeks. And we're going to look at some analysis about that. Ethereum is up, though, on the week, up 10%, up 3.9% in the last 24 hours to $2,387. Binance coin also up on the week, 12.7%. It's seeing some nice gains. Up in the last 24 hours, 6.9%. Currently $339.27. Cardano is up 4.6% on the week. No change essentially in the last 24 hours, though. It is currently $1.43. Dogecoin is down 11% on the week. Currently 23 cents. Polkadot up 10.1% in the last 24 hours. That's putting it into the green on the week, 5.9% increase. Currently $17.25. Uniswap saw a nice increase this week, up 24.1% to $23.11. Solana is up 9.5% on the week and 9.2 on the 24 to 37.16. This number of the altcoins saw some nice gains. It's a mixed bag, though, when you get down into the lower cap altcoins. Polygon not really seeing an increase on the week. Ethereum Classic down a little bit. Internet Computer down 11%. Beta Network down 9%. But there were some others that really saw a nice boost. Aave being an example, up 36.7%. Cosmos up 13%. Terra up 20%. Let's see what else. Maker up 20%. Compound up 54%. Avalanche up 14.8% on the week. Thorchain, Kusama, the Graph up 29.2%. Synthetics Network Token up 60.4%. I'm just trying to snag a few of these. That there's been a number of altcoins that have really been pumping. Engine Coin up 23%. Stacks 34%. KuCoin token up 80%. KuCoin just took off. It was like $5 something just a couple weeks last week. Now it's up. It was up like 40% yesterday, up 20%. Anyway, currently 13.27. That's one that I've been keeping an eye on, expecting might do very well. What else do we have that's doing? There's just a lot. Okay, Axie Infinity up 219. I know that Flow up 62%. I know that Singularity's DAO token was up 200%. So if we sort for, let's just do that on the 7-day and sort for 7 days and see what we got here with some of the winners. Titan Swap, KuCoin, Echo Me up 79%. Flow, mentioned already, Synthetic Compound, Aave, Stacks. Harmony 1, been talking about Harmony 1. It's seen a nice increase, up 33.7% on the week as well, up 27.4% in the last 24 hours. Decentraland up 29%. The Graph, all right, that's enough for the market, but you can see that we're starting to see some of those altcoins really pump. All right. Bitcoin's mid 30,000 struggle and 2.87 billion crypto whale spike. What do we have going on here? This coming from Forbes.com. Following a fresh wave of regulatory crackdown on cryptocurrency mining operations in China, Bitcoin saw a historic difficulty readjustment of nearly 28% last Saturday. Yeah, that's pretty significant. Bitcoin mining difficulty down 30% almost just last Saturday. The Bitcoin network automatically adjusts the level of difficulty it takes to find a new block approximately every 2 weeks, or 2016 blocks, based on the amount of computing power on the network, so that new blocks are added on average every 10 minutes. In the near term, the remaining miners, especially those outside of China, stand to collect larger profits. However, the market shows signs of stagnation. So, this is an interesting thing. If you've been considering buying an ASIC and doing some Bitcoin mining, now it might be a really good time. For a number of reasons, but one, this very reason here, that the difficulty is dropping. So you're going to earn more than you would have prior to this crackdown on China. And, it's interesting because this is one of the reasons that many analysts are saying that this China quitting Bitcoin thing is a good thing. And one example of that is Anthony Scaramucci. To jump to another of our stories for the day, CEO and founder of Skybridge Capital, Anthony Scaramucci, has talked to CNBC Squawk Box host Melissa Lee about the impact of the crackdown on Bitcoin miners that has recently been initiated by the Chinese government. The situation may be negative for the price at the moment. Scaramucci, however, in the long term, says the clampdown will be beneficial, with China moving out of the way. China getting out of the way is very positive for Bitcoin, according to Scaramucci. While some are worried a lot about Bitcoin's current decline, Scaramucci believes that, on the one hand, The Chinese interference with miners has made the flagship crypto very volatile and pushed Bitcoin from the $65,000 all-time high reached this year over 50% down where we're at today. Still, he says that in the long-term prospect, China is moving out of the way with its mining based on fossil fuels, thus helping to gradually solve the environmental issue of Bitcoin. Scaramucci reminded that, according to Michael Saylor, the CEO of MicroStrategy and head of the Bitcoin Mining Association, 56% of all Bitcoin mining operations are performed using green energy. So I agree, Scaramucci, with Scaramucci here. It's a good thing in the long run. Yeah, in the short term, China's crackdown, and there's more stories about it every day. Just today, there was a story about China forcing one of its banks to not fund a company that was engaged in crypto investing, trading, etc., this sort of thing. So, they're going after it quite seriously in quite a draconian, communistic type of way, as we would expect. It's this sort of thing that happens in a country in which you're not free. And they are increasingly, it sounds like, from all the reports coming out of China, losing their freedom. Interesting. China has seen so much success as it moved toward the direction of more openness, more freedom, more capitalistic engagement around the globe, and now definitely reversing, especially in the crypto sector. So going back to the Forbes story, this analysis, Bitcoin is struggling to break out of the $34,000 range, trading at $34,618 as of 6:50 a.m. Eastern Time. According to the data from Coinbase, Bitcoin's price has been range-bound between $33,197 and $35,909 over the last 5 days, with a 5-day change of 2.4%. According to the CEO of the crypto derivatives platform Delta Exchange, Pankaj Balani, Bitcoin is in the consolidation phase between $30,000 and $42,000 zone, and he expects it to spend the next few weeks testing this range on either side. There are limited catalysts here, says Pankaj, for any break on the upside in the short term. On the downside, however, weakness in the economic data is a concern, and weakness in the broader markets or reduction in liquidity can cause sharp down moves in Bitcoin. We see this reflected in options data, as well as with puts trading at a premium to calls for July and August expiry. These observations dovetail with an overall tempering of the market after a volatile few weeks. The short-term volatility is now at 2 months low. Now that's very interesting. Short-term volatility is at a 2 months low, reports the Norwegian crypto analytics firm Arcane Research. So volatility is low and decreasing, at least over the last few weeks, which is a significant indicator that consolidation is occurring. As analysts are looking for clear signs in the broader market amidst this relative tranquility, crypto whales, individuals or entities with large amounts of crypto holdings, are ostensibly buying. On July 2nd, 18 new whales surfaced on the chain, and the total Bitcoin balance held by whale entities shot up by 82,760 Bitcoin, or 2.87 billion at current prices, according to on-chain analyst Will Clemente. The spike leads me to believe, says Clemente, we may finally start to see some new big buyers step in. It's a bullish sign. Additionally, a new survey by Nickel Digital Asset Management shows that 200 million UK crypto hedge fund found that 82% of institutional investors and wealth managers from the US and UK, France, Germany, and the UAE who currently have exposure to cryptocurrencies and digital assets expect to increase their crypto holdings by 2023. That is just a survey, sort of anecdotal, but that's significant. 82% of institutions are saying they're going to increase their crypto holding by 2023. That said, not all are convinced that we are out of the bearish woods. Ben Lilly, a crypto economist at trading and analyst platform Jarvis Labs, writes, while we wouldn't be entirely surprised to see the price run higher, we are leaning towards downside movements in the near term, which means even if price drops pop higher, we expect price will lack momentum and ultimately retest $32,000 to $30,000 support. Meanwhile, other top cryptocurrencies, including Ethereum, BNB, Cardano, and Polkadot, are up on the week by 4.2%, 9.2%, 2.8%. Yeah. Following up with the analysts' statements from, as reported by Forbes, one of our favorites, Willy Boo, is pointing out that there's the potential for a supply shock underway as the Bitcoin withdrawal rate spikes to 1-year high. He says the supply shock is being unnoticed, similar to Q4 2020 before the price of Bitcoin skyrocketed. So we shall see, but here's the argument. Willy Woo, an on-chain analyst, anticipates a potential supply shock in the Bitcoin market as long-term holders continue raking a Bitcoin supply from short-term ones. So the long-term whales, generally speaking, are just coming in and buying up as the newer short-term holders, typically smaller retail investors, sell into the market. Wu stated in his Friday newsletter that the process might push more Bitcoin out of circulation. The analyst referred to the ratio of Bitcoin held by strong hands versus weak hands, also known as Bitcoin supply ratio, noting that the former is actively absorbing selling pressure from whales who have been dumping their crypto holdings since February. It reminds me of the supply shock that went by unnoticed by the market in Q4 2020, wrote Wu. Pundits were debating whether Bitcoin was an inflation hedge in a post-COVID world when the data was pointing to long-term investors stacking Bitcoin at a fast pace. The price subsequently went on a tear, very quickly decoupling from the tight correlation with stocks. According to Glassnode, another on-chain data analytics service, the Bitcoin network has been onboarding an average of 32,000 new users. Get this, not every week or every month, every single day. 32,000 new users. I mean, it might be less than that because this might be an assumption based on how many new addresses are being created, but Glassnode's pretty good. 32,000 new users, that's a lot. The Bitcoin network user growth metric last topped in January 2018, hitting approximately 40,000 before correcting lower alongside the prices. It showed that new users stopped coming to the Bitcoin network as its price crashed from the 20,000 top in January 2018 to as low as 3,200 in December of 2020. Well, that is something just crazy to remember. Just brought to my mind, if you're thinking that things are a bit rough in the crypto space right now with Bitcoin at 30, where are we at? 34, 32, 33, 44, 34, I think is where we're at today. Lost my internet connection on the PC apparently. Bitcoin 34649.27. Yeah. Look, it was 3,200 in December of 2020. So there's not much to complain about. All right, moving on. Good news for Ethereum. Ethereum's London hard fork is set to launch on August 4th. And this is something that's been well anticipated and constantly delayed. That's the best way to describe that. This was actually supposed to happen earlier. It was expected to go live this month, but we're pushing it back once again, now to August 4th, according to developer Tim Biku in a recent blog post. So following the successful release of its 3 testnets, Ropeston, Gourley, and Rinkeby, London is one more upgrade on the road to full implementation of Ethereum 2.0. which will transition the popular blockchain network from proof of work to proof of stake. So what will this London fork do? It's going to implement five much anticipated Ethereum improvement proposals, also known as EIPs. So there's EIP 1559, which will make fees less inflationary, and more predictable, and also decrease mining revenue. You know, interestingly enough, also Ethereum's Bitcoin mining difficulty has dropped by close to 20%, which I would assume is a result of the crackdown in China as well. And not only are they not mining the Bitcoin, but they're not mining the Ethereum. So in this short period of this window between now and when Ethereum actually becomes fully proof of stake and the mining gets shut down completely, profitability is up, or theoretically should be up. There's also EIP 3554, which will delay the difficulty adjustment until December in preparation for the network's shift to proof of stake. So we've got July, August, September, October, November, December. We've got 6 months, once again. 6 months to continue to mine Ethereum if you're an Ethereum miner before that difficulty adjustment is, said to kick in. Israel's new president will receive an NFT of the presidential oath. That's kind of cool. It's the first time this has ever happened in history. The Israeli parliament has decided to inaugurate the president and to give him an NFT with it. That's fun. All right, let's move on to our last segment of the day, which is inflation. We're talking about inflation. We've been talking about inflation. We've been doing this series here with inflation, the insidious thief. And this data is being brought to us by Kraken Intelligence. They've done a really fantastic job, and that's why I wanted to share it with you guys. And right now, we are on the section that has to do with what are the consequences of high inflation. What are the negative and positive results of inflation? And last time we wrapped up with just a little bit of data about what kind of inflation we've seen in the United States. And we saw things like hospital services up 200%, college tuition and fees up over 160%, textbooks close to 160%, medical care services 120%, childcare, nursery school 100%, average hourly wages up 80%, housing up close to 80%, food and beverages up close to 80%. So all the services and anything that has to do with medical and housing and food, all the things we really, really need, right? Then the things you don't actually need that you could probably go without or even get at a thrift store in some cases. Cars, well, not a thrift store, but clothing, household furnishings, and then some of the services, tech-based, manufacturing-based things like cell phone services, computer software, toys, TVs, just because these have been deflationary and have become more affordable over time. But that is a result of advancement in the productivity in making those things, right? So moving on, what are the effects of inflation? Positive, negative. We talked about the increase in labor supply. We talked about in the increase in demand. And these two arguments between the Austrian School of Economics, guys like Murray Rothbard and Ludwig von Mises, and the Keynesians. Of course, Paul Krugman being one of the most notable and followed Keynesians of today. Figure 2 here is a nice chart that shows a contemporary example on the performance of fiat currencies and scarce assets in the face of inflation by displaying the real inflation-adjusted purchasing power of the US dollar, the euro, and Great Britain pound, in contrast with US-denominated Bitcoin price. Though there are some immaterial exceptions, it's clear that major fiat currencies have steadily declined throughout the last 11 and a half years, while Bitcoin has inversely posted significant returns. So if we're looking at this, the real purchasing power, inflation adjusted, of the US dollar in 2010, Bitcoin was 30 cents to the US dollar. 2011, $4.85. 2012, $12.97. 2013, $698. And this just goes on and on and on, where today, the US dollar's purchasing power is 83 cents of what it was in 2010, right? So, it's lost, whereas Bitcoin is now 30,000. So doing the exact opposite and in a significant way. All right. Well, that's where we wrapped up last time. And today we're going to talk about the impact of the debt to GDP ratio, the government debt to the gross domestic product. All right. Sit tight. This gets a little bit heavy, a little bit heady, but it's worth understanding. So let's move forward with this. GDP corresponds to the amount of taxable revenue a government has to help pay down debt. When debt to GDP is low, it means that the country is in an excellent position to pay back its debt. And when high, the government has a greater risk of defaulting. For reference, a study conducted by the World Bank states that a ratio exceeding 77% for an extended period may result in an adverse economic impact on a country. At the time of writing, data from the U.S. Bureau of Public Debt showed that the U.S. debt to GDP ratio stands at a whopping 107.6%. So the World Bank is saying that 77% for an extended period might result in an adverse economic impact, and we're at 107.6%. And it is nearing levels last seen in 1946, following World War II, when the metric hit an all-time high of 118.9%. This is notable as the majority of that debt value was inflated away in the decades that ensued until the debt to GDP hit 31.7% in 1974. Because most interest payments are fixed in nominal terms, inflation makes the current debt value diminish in real terms. At least three factors contributed to the government's debt being inflated away following the war. The economy. So the question is, will that happen again, or will we go in some other direction, which could be catastrophic? But this is what happened following the war. Following the war, which pushed the debt to GDP ratio up to 118%. The economy, number one, the economy rapidly expanded at an average pace of 3.7% per year from the late 1940s to the late 1950s, which translated to massive tax revenues. Also, U.S. manufacturers saw little international competition as the war destroyed Germany, UK, and Japanese factories. All right, so that's something that's not true today. After the war, the U.S. government rolled back price controls, causing inflation to soar, and thus bringing in more tax revenue to pay down depreciating debt. You see that? Inflation is good for the government from the standpoint of paying down their debt. This is why the debt to GDP ratio is so important in this discussion, because it tells us, this historical data shows us that the government needs inflation in order to pay down its debt, in order to bring down the balance in the debt to GDP ratio. You get it? So, but going back to the historical argument here, let's just reiterate here. Number one, what happened that helped balance that debt to GDP ratio back then after the war was the economy rapidly expanding, which was partly due to the part that we were manufacturing all kinds of crap and the rest of the world wasn't because they'd been destroyed by the war. Then also price controls were rolled back and inflation soared. All right. Because government bonds yielded significantly less than the 76% rise in prices between 1941 and 1951, real government debt obligations fell sharply. And then number three, the average duration of debt in 1947 was more than 10 years, about twice today's average time. So here is the negative of this inflation, the decline in purchasing power. This is going back to answering the question of what are the effects of inflation. And this is a negative. Decline in purchasing power. The most blatant impact of inflation is that necessities such as food and shelter become more expensive because consumers will purchase goods and services in anticipation of higher prices. Prices rise further and purchasing power falls. Those with lower socioeconomic statuses are the ones most impacted and must undergo material lifestyle changes. Yeah, when inflation starts to really kick in, and everybody notices that the prices of the things that they need are rising. This is when we see the mad rush to the grocery store to load up the shopping cart with everything you possibly can. Or the lines to fill up your gas tank because it's going to be $1 more tomorrow or something to this effect, right? That's when we know that we're starting to see some serious problems. However, according to this chart, looking at this thing here, for those on video, this is insane, right? If you can't see it, the podcast audience, I'll describe it. Here's the average purchasing power of the consumer dollar in U.S. cities. All right. In 1920, it was at 1,000. There was a precipitous drop, which obviously was brought on by the Great Depression, right toward the end of 1920, beginning of the 30s, right? And then it's climbed up a bit, went stagnant for a while, maybe 4 or 5 years, and then shot back up, actually, in the 1930s after the war, the purchasing power. And then it just started to decline. And it's been declining ever since. Declining. Down so low that it's going toward zero. It is trending toward zero. From 1980, we've probably seen till today about just based off the chart, rough glance, 40 to 50% decrease in the purchasing power of the dollar in U.S. cities. This is from the U.S. Bureau of Labor Statistics. This chart in and of itself should just freak the crap out of anybody and everybody, and make you say, whoa, wait a second, what? I mean, if I had $1 million in 1980, it'll buy what, $500,000 will buy, sorry, reverse that. It takes $1 million to buy what 500,000 bought back then. And we see this, obviously. Looking at properties and you're like, wait a second, that shouldn't be 400. That shouldn't be 2.5. That should be like half of what that is. And it isn't that real estate just going crazy. And I mean, in some places it is, as there's a mass exodus from. There are supply and demand issues. There are other factors, sure, granted, but a huge factor is the fact that the purchasing power of the dollar has declined. So things aren't really getting more expensive. In fact, most things are cheaper to manufacture, or they're manufactured in a more productive or easier way, faster, cheap, whatever. But they still cost more because of this factor of what happens with inflation, the creeping slow inflation, and then sometimes fast. Speaking of fast, what happens when inflation gets out of control? Right? This is the next question tackled by Kraken Intelligence. History has consistently shown that too much inflation is detrimental to an economy. When the money supply expands too much, it causes rapid, excessive, and out of control prices, increases of 50% or more per month, or what is known as hyperinflation. There's the bad boy. Hyperinflation. Man, I tell you what, I sure hope we never see that in our lifetimes, but the data seems to indicate, and history seems to indicate, and just the human nature, the nature of government, the nature of regulatory agency, the nature of a central bank, the nature of the Federal Reserve, all of this would indicate that it's most likely that we will. Hyperinflation usually occurs when a central bank expands the money supply too much and too fast during tough economic times. Hyperinflation negatively impacts an economy in several ways, such as the native currency's value falls relative to others and has significantly less purchasing power. Consumers stockpile goods in anticipation of higher prices, causing supply shortages. Consumers withdraw deposits and stop depositing money at banks, thereby limiting lenders' ability to operate. Less production and spending means less tax revenue, forcing governments to run a budget deficit and limit social services. So this is the game that the government has to play. They want to inflate. They need to inflate. They have to inflate in order to try to pay down the debt, but not push it too far. Because if it goes too far into hyperinflation, then it means less tax revenue, less spending, less production, forcing government to run an even bigger budget deficit and limit social services. Venezuela, Hungary, Zimbabwe are all examples of countries that have experienced periods of hyperinflation. Hungary experienced the worst case of hyperinflation in human history following World War II in 1946. At the time, the daily inflation rate was over 200%. The daily inflation rate, meaning the average price of goods and services was doubling every 14.8 hours. The government stopped collecting taxes altogether because just a few hours of delay in paying taxes could decimate its value. Workers had to pay the price of this hyperinflation as real wages fell 80%. So they were making the same amount in nominal terms, but their purchasing power fell. That's why they're saying real wages fell by 80%, forcing them and their families into abject poverty amidst a devastating supply shock. Moreover, hyperinflation eradicated creditors because loans lost their value before debtors repaid them. Yeah, that's an interesting side effect. Suddenly, there's just all this money floating around all over the place. And if you're able to, if you're not on a fixed income, or with a job at a set wage, the business owners who had loans, they were able to just raise their prices, take in massive amounts of money and pay those loans off like that. It's such a convoluted and abstract and obtuse system, the whole credit system and whatnot. And it really does depend on the central bank system, fiat system, with the built-in inflationary aspects and interest and all these things to work together in such a way that once it gets out of imbalance, man, it just creates devastation throughout the entire system. So here is a chart of the highest hyperinflation events throughout history. We got Hungary, Zimbabwe, Yugoslavia, Republic of Germany, Greece, China, Armenia, Turkmenistan, Taiwan under Japanese rule. Happened all over the place. In some instances, the worst was Hungary. It took 14.82 hours for prices to double. In Zimbabwe, prices were doubling at the high at every 24 hours. Yugoslavia, 1.39 days. Can you imagine? So like every single day. First day you go to the gas station, it's $3.50. Next day you go, it's $7. Next day you go, it's $14. Next time, shoo. And then in Zimbabwe, they just kept creating bills with higher and higher denominations. They've got one here for $10 billion. Oh no, $100 trillion. They had a $100 trillion bill. All right. That's enough for today. The insidious effects of hyperinflation. Tomorrow, we will look at monetary policy, which strives to keep inflation under control. Will they be able to do it? That is the big question. We know that there's going to be inflation, and this is going to be very positive for the cryptocurrency space. The question, the big question is, will they be able to hold off hyperinflation? And if hyperinflation were to hit, what impact would that have on crypto? Would it just be so destructive to the entire system that crypto as well would be devastated? Or would people rush to it as a safe haven, as a deflationary asset, as something to try to hold on to something? It's a big question to think through. In Hungary, Zimbabwe, Yugoslavia, Germany, Greece, China, all these places that experienced this hyperinflation, if the people had at the time had Bitcoin to go to, would things have been different for them? I'll leave you with that thought. Thank you so much for tuning in. I love and appreciate y'all. Talk to you tomorrow. Goodbye.